if you're looking at total stock markets and you're looking at extended markets, total international, emerging markets, those larger index ETFs are going to cover a large swath. And if you're building portfolios like that, you should be in a pretty good spot. The key is control your emotion.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am your co-host, Chad Chubb. I'm joined by the one, the only, the magical, the man that needs no introduction, but he's going to get one here, Tyler the Olson, my friend. The listeners don't take these little breaks, but we take these little breaks. I'm gonna be honest, I miss you. So it's good to be back on here.
I miss you too. I love these conversations. And I'm wondering, what did you eat this morning?
Oh, I'm always full energy. I did have some coffee. I'm finishing up my coffee now, again, towards the tail end of it. As my wife would say, I'm usually too much early in the morning, and I guess we're still early. I wake up, I'm ready to go, man. I'm excited for the day. Now, by the end of the day, I think I made this joke on past episodes. We are like, we're a young couple that act like, 70, 80-year-olds. We're usually asleep by 9. So my high energy will start to tail off as the day goes on. But right now, I'm ready to rock and roll.
Well, I love it. That's why I like when you do the intros.
So, coffee's a magical drug.
It is, yeah.
I should say caffeine probably is the magical drug inside of that.
Mm-hmm.
All right. We got a good one here. Shout out to A. Evans. I think it would be broken A. Evans, but I won't give the whole email address just to keep you safe. But this one is for you, my friend. You submitted this question back in April. We're doing pretty good on our timing here. We're by the time of recording, this was actually just submitted, but it'll go live. This should be our June 1st episode. And I love this question because, Tyler, I recently told you that some of our best episodes, and we haven't really done too many deep dives on investments and portfolio builds. Today, that changes, my friend, thanks to our friend A. Evans. So the goal today is how to build your portfolios when you have numerous accounts, which for many of our listeners and clients, this is where we're headed. Whether you're there now or you're heading there, you're going to have numerous buckets. So that's what we're going to dig in today. I think these are fun topics too, because we are two different financial advisors. We have two different practices. While I do think that we align on many things, this is probably a topic where we each kind of have our own nuances and things that we do here. So before we get into the specifics, my first question to you, Tyler the Olson, what is your approach to investment management, big picture, at your practice?
I would say the primary driver is keep it simple. There's so many options out there. And in the first 10 years of my career, I just dove into the complexity, options, trading, futures, the futures market, commodities, private investments, mutual fund managers with fantastical ideas of how they can beat the market, leveraged ETFs, all these things come to my mind and they just make me want to fall asleep because they are they're just, when you deal with them, like, and you're like, you hold them and you're like, okay, I'm going to make this a part of my plan for success. You have so much more to pay attention to, and it is so annoying and stressful. So I try to keep things as simple as possible. I make sure to tell any prospective clients that this is my approach too. I think they probably can sense it too from any sort of education that I put out there. Because like, I don't like people that are like, oh, like I want to do some complex things. I want to beat the market. Like I've heard about this and this and this, and no one knows about it yet. And let's like jump in. Like that is not my speed at all. I like investment management to be like my Honda CRV. Just, it's going to be there. I know how it works. It doesn't have all the bells and whistles, but I don't care because it's just going to get me from point A to point B. And I can actually devote a lot more attention to other areas of my life. How about you?
Yeah, well said, my friend. Yeah, very similar. I have a follow-up question I will send to you in a second. But big picture, very similar. I'm often on the record saying to a lot of our clients, I think up until $5 million, which for some of you that may sound like a large number, for some of you, you might already pass that number. I believe that you should be extremely simple, low cost, diversified, indexed ETFs. The biggest thing is control your emotions. If you can control your emotions, you should be really, really, really in a good spot in the long run. I'll be honest, I did not expect you to drop that much technical jargon at the start there. You dug deep there early. See, we used to manage portfolios in-house, which will be a follow-up question for you in a second, early on. And then we realized, similar to what you said, that the value add is in today's world, at least in I would say in our opinion, is not from, hey, we have this magical sauce, try this Kool-Aid type thing. It's more in the total comprehensive planning. I again, on the record saying all the time, I think tax planning for a lot of financials is their biggest value add, especially in today's world. After 5 million, do we sprinkle in some more unique things? We do, but it's not to beat the market. Usually it's actually more of a goal to try to find assets that are not completely correlated to the market. And maybe that's where we're getting into, maybe we'll bring in some form of private alternatives where maybe there is some real estate in there. Maybe there is some private equity. Maybe there is some infrastructure. But the goal there is not to beat the market. Clearly, we want to keep pace with whatever index we're trying to track. But the goal there is to more or less decouple from the markets as your net worth kind of hits these new high watermarks per se. Mm. My follow-up question to you, because I believe we are aligned on this one, do you manage assets directly in-house? Meaning for the listeners, are you building the portfolios? When it's time to rebalance, are you going in and doing that? Or are you using outside called sources to help you on the investment management? I know this is more of a recent ad for you as well.
You're talking about model portfolios.
Yeah, I wasn't going to use the word model, but yes, they are model portfolios. Yes.
Okay. So we have used some model portfolios, but we actually, to align more closely with our financial planning, I mean, it's embedded in the software that we use for planning work. In order to meet the timelines and at least our experience with what our clients need and want and what they're comfortable with. In our planning software, we have very specific allocations, and that has led us to making our own custom portfolios. Now, once we make them, they're set as far as percentages are concerned. So the work of building them for our clients, it took some time, but now that they're built, they're just we can just, depending on the array, the degree of risk that a client is willing to take on and such, that we have an array of what do I call it? A spectrum of risk level that we can choose from, but it's our own internal portfolios that we've built. But you use outside sources, right?
Yeah, we have for a long time now. In our world, financial planning world, for our listeners, we call them TAMPs, third-party asset managers per se. So we find these TAMPs that we believe in their strategies, we believe in their fee structures, we like the way that the way that they do things, and then we'll pick the models that align best with our clients. And again, under 5 million, the bulk of our models are very much what we call modern portfolio theory. When clients come to us for a one-time plan, and we're not going to manage assets directly, we usually will use a simple 4, 5, 6 fund portfolio. When we manage them in-house per se, we'll maybe add in a little bit more satellites in there. So we'll, maybe it's 10 to 15, but they're almost always, really always, index ETFs is what we're building with. But we'll build in those models. And from our side of it, it comes down to, while we know the risk tolerance our clients should be in, I don't want to have to know every single fund in there. I don't want to have to get in there and rebalance. I don't want to have to pull funds out to send you that. I want to rebalance you back to a Roth, because at the end of the day, you can outsource that for today. That's the beauty of it. It become so commoditized that the prices continue to go down, whether that's the actual platform fees or if that's the actual ETF costs in there, it's continuing to drive those costs down. So for us, the bigger value add is, hey, let us be your great comprehensive financial planner. You won't know that investment management is being outsourced because it's so ingrained in everything that we do, but we trust other firms to go in and build those models. We find the models that match up. And truthfully, Tyler, I mean, for us, that's been helpful. Again, usually north of 5 million. But, when we get into SMAs, separately managed accounts, and we get into direct indexing, those types of things, it would have been very hard to have the mental capacity be as comprehensive of a financial planning firm as we are, to then also plug in all the due diligence and all the research that comes in with at least having these other investment options. So we have always had that platform. Like I noted early on, we would build some portfolios on our own, but even then, they ended up looking like modern portfolio theory. So we have always done it that way for, 15 years now.
I don't remember who your platform is, but this is a major shout out to Altruist, because building our custom portfolios on their platform, we can integrate rebalancing with our percentages where they'll do it. I've toyed with the idea of a TAMP. It just seemed like more than we needed. But I mean, you're also a bigger firm than I am. So I don't know. There's more than one way to go about this from a planner's perspective. And I can see, and I remember learning about like some of the back office work that you're connected with. And I think it's fantastic. I think, yeah, I don't know. Now you're making me think, and I'm like,
Well, yeah. I mean, to your point, though, I think when we were a smaller firm, that's again when we were even building our own models, because it wasn't as crazy. Now, based on households, also just based on the total assets under management, the numbers are a little bit more scary. If I'm the one pressing the buy sell buttons, like those numbers are serious numbers. So for us, it was also kind of just growth with that. But I know Altruist, I even know some of the other model. I feel like a lot of advisors today have made this pivot where they see what we see in terms of, hey, our big value add is not this. We're not selling you, hey, we can beat the market, because it can't be done, at least not consistently. So you're seeing more and more advisors where they're building their own models and then using an outside platform to kind of rebalance and keep it organized, so you're not the one kind of going in there day to day. Or they're using a TAMP that kind of does everything for them, and it's all organized. And again, those have their own platform fees with them. I always compare to like the Vanguard PIS system. I think they're still at 30 basis points. Like, to me, like that's a fair price for a TAMP. 30 basis points or lower for someone that's only in there managing the numbers. And ideally, with assets, those numbers continue to come down as well. So I thought that was an interesting question, because again, I know that we both do it different ways, but like you said, there's not a perfect way to do it. If you're watching this and you're interviewing other advisors, these are good questions to ask. What's your viewpoint? What's your strategy? How do you do this? I think it's just a really neat way to see how different bakeries are making bread per se.
Yeah. I think the higher a person's assets are, the more I'm like there's a few couples within the past couple of months I'm thinking of that I work with, where now their household income is it's so robust and their net worth is just skyrocketing, that they happen to have some like personal relationships with people that have like startups going.
Yeah.
And they're like, hey, we could invest 50,000 in this. And I think then it's almost like, all right, you're above the clouds now, where you're really soaring, and you're kind of like, okay, I think we have some brain space here for this. Like you could lose this entire amount and it would be fine. Which, I mean, it's kind of surreal when you get to that point, especially for you, when you doctors are coming out of training and you got negative $500,000 in debt, and here I am talking about losing $50,000 and being like, well, you don't like it, but you'll be okay. Like, but it's another world for sure. But I think, yeah, to your point about net worth, like 5 million plus, 10 million plus. Yeah. Like I can be convinced to look at more complex things if there's like a niche reason. I don't know. I so much err towards simplicity, because like, this is a tangent, but I think it's worth it. I was at the gym last week and I was talking about business development stuff with my trainer, and the person who was there next to me, who was working out with his trainer, he heard me, and he's like, I think he's probably like 60 or 65, something like that. And I was talking about like, yeah, like I think about growing, the business, developing, whatever. And like what I should do to try to grow it. And he looked at me and he's like, He's like, son, you've got it made right now. He's like, I was of the mindset that I was just going to grow and grow and grow. And I did. And I've been financially successful. But now I can't find someone to replace me. So I can't quit, even if I wanted to. Like, he could and just like the business implode, but he cares about his employees. And that really, from a personal standpoint, that really spoke to me, to appreciate the simple, like if you're in a simple space, if you're going to venture into something complex, and of course, this is like business development. This isn't investment management. That's why it's a tangent. If you're in a simple space and you don't really have to think about much and you got what you need, you got to really think about the cost of the complexity. Is it really worth the hassle? And maybe it is. Maybe it is what you really want your life to be about. Some people want their entire lives to be about their businesses. But I do think that that's a dangerous place to be, because then you get to a point where you have to ask yourself the question, what am I going to retire to? And they don't really know, because they have no hobbies and they don't have any friends. You know, they just have business partners and they just have their business. So I think it's tricky. Anyway, I think that there's some principle somewhere in there that applies to investment management decisions.
Yeah, no, I think there is a deeper message. I mean, and this is not the point you were trying to make, but even in especially early on, not now because we have a larger team and the team essentially they're all smarter than I am now at this point anyway. But I always would joke with clients like, hey, even if I get hit by a bus tomorrow, one of the good things about using a TAMP is that is already built for you. Now, again, you want someone still driving the bus, but I think there is, from a practice standpoint, there is simplicity in also bringing in these TAMPs. And yeah, again, depending on net worth, some clients are 10 million plus. We literally have a client retiring probably this year, 10 to $15 million. We present, hey, here's some cool SMAs, here's some direct indexing, because a lot of it's non-qualified money. We like the direct indexing just to kind of harvest losses. And they're like, no, I appreciate it. I understand the benefits to it. I do want to keep it simple in what we've been building. I'm like, perfect. We love it. Let's keep building this way. Or other clients, especially in the physician space, you always have like, oh, I want some private equity. I want real estate, right? Real estate's the main go-to, which is a side topic. I don't know if you're getting the same feedback. There is a lot of like scary syndication news out there. We won't go on that tangent right now, but we've had numerous clients get back to us in like last few months of like, this is not looking hot. Another story for another day, another episode. But I agree with that. I do believe in simplicity. I believe in keeping things organized. I do think for a lot of our clients, that's one of the benefits to also having advisors, that they can ideally keep this more simple for you, whether that's your total financial plan or your investments. But regardless, I digress there. All right, let's come back to A. Evans. All right, so the accounts that they put in the question was they listed an HSA, a Roth, a 403b, and brokerage accounts. I think for the most part, our Roth and 403b will likely end up looking similar. So I'm going to say there's three buckets. We got an HSA, let's just call it qualified money, long-term qualified money, and then we got brokerage accounts. We don't know the specifics. We don't know what their financial plan looks like. We don't know their age. We don't know their net worth. We don't know how close they are to retirement. But let's just assume that most of our listeners, most of our clients are younger accumulator years. We still got, at least 10, 15, 20 years plus until retirement. Big picture, how are you looking at those three buckets? Again, HSA, qualified money, which incorporates the Roth and the 403b, and then the good old brokerage account, whether that's individual or a joint account.
So I always start with the viewpoint that all the money, regardless of where it's located at, is part of one big pie. And it needs to be subdivided in accordance with one's goals, the time frame for those goals, and your view of investment risk, your view of how you receive stock market news, because things are going to go wildly up and wildly down at times. And so you got to all that leads to a discussion, or a decision about how much am I going to be investing in stocks? How much am I going to be investing in bonds? And how much cash am I going to be keeping, from the most basic portfolio perspective. And then if you are, if you're out of training, and so you've got an HSA, you're doing backdoor Roths every year, you got a 403b, maybe a 457b, and you're building up a taxable account, you need to aggregate all those numbers into a place where okay, amongst all these accounts, I've got $500,000. Maybe, and if that's the case, then your decision of what type of investment array is appropriate for you will then dictate how to divide up that $500,000. That's the first step. And you don't necessarily make investment decisions just from that step. You then have to look at, okay, well, if my portion of my $500,000 is I'm going to put $50,000 into bonds and $450,000 into stock, let's say no cash, 90% stock, 10% bond for this example, then where is that $50,000 going to go? That's asset location. 90% stock and 10% bond is asset allocation, which is how it's divided. Asset location is where are those portions going amongst the different accounts. And this matters because a brokerage account investment performance is treated differently from a 403b account investment performance in terms of tax implications. So like you have to have those two layers to make sure that you're not being tax inefficient. And then once you figure out the best location for the assets, that's when you can then okay, we're going to invest this much here, and this much here. And then, I could keep going, but what do you think so far?
Yeah, it's essentially how we're looking at it too. I think we've discussed it in the past. One of the unique things we do with brokerage accounts, again, it depends on the situation, but for brokerage accounts, traditionally, we will use a little bit more of a moderate allocation, at least up until a certain threshold, because our theory has always been we consider that our level 2 emergency fund. So you're going to have your actual emergency fund, sitting at Ally Bank, Marcus, Laurel Road, wherever it's at there, it's parked there. And then we kind of have this middle of the road account, which we consider that your brokerage account, whether that's individual or joint. And historically, we will use more of a moderate allocation there. Some clients maybe more risk, some clients less risk. We sprinkle in municipal bonds. Most of you are in high tax brackets. So if we're going to add in bonds, we like municipal bonds. We do diversify between municipal and traditional bonds. And then for most of our clients, 403b, 457b, Roths are going to probably be pretty heavy pedal to the metal. For the bulk of our clients, again, this is a broad stroke of the brush. You're probably looking at all equities in those buckets. And then the HSA, this would be a fun one to talk through too. On the HSA, traditionally we tell our clients, hey, we're looking at that as a long term. You're not using this until you're 60 or 70 years old and your actual healthcare costs go up. Meaning that when you do have medical expenses come up, you don't tap into that HSA. You pay those out of pocket. If you believe in that theory and you're cool with that idea, there you're going to be pretty aggressive again, because we're trying to get decades of growth so we can go through some market volatility and we'll be fine. The one unique thing with HSAs is we will have a conversation with our clients is, do they want to keep a certain amount in cash? Some of these HSA providers require it, so whether it's 1,000 or 2,000, but some clients will like to keep some in cash just in case. They're doing good, cash flow's good, but I think it's just a feel-good mechanism. So we might keep some in cash, but then invest the majority of it for that long-term growth. So that's kind of how we look at it. If we had to break those buckets into broad strokes of the brush, that's how we would be looking at it, which I assume that's pretty similar for you. I guess my follow-up question would be, is that how you have a similar approach on the HSA?
Yeah, presuming that this is usually the case, but not always. We just check and make sure that cash flow is such that we can confidently say the HSA funds will not be needed, barring some extreme medical emergency that ends up costing a lot. Then, of course, it might be wise to use the tax-free funds. But barring that, we take that very, very long-term approach too. It's just like an extra retirement account.
Which, again, all of those also, the account, we're not going to talk about this in terms of asset allocation, but the emergency fund is still king or queen here. That is very telling to how a lot of these will look as well. But in particular, the brokerage account and the HSA, because those are funds that could be accessible near term. Tyler, when you're building out these portfolios, I don't think you need to give one of their questions with specific funds. This is always the number one question to investment management, which it's very hard for us to give specific funds. I have a list here that we put in our Wealth Kill snapshot, just an internal document. When you're looking at these or in your models today, you don't need to give me the exact fund family, but are you using mostly index funds?
Yes.
Okay.
Yes. The data on passive versus active management is sufficient to me that there are some niche scenarios where a real estate fund or maybe a bond fund. There are some management firms out there that do a decent job with bonds. where maybe it might be worth, paying their fee. But even in that array, like the management fees I'm thinking of are like point 4 to 0.55%. So, none of this 1.08 C share garbage, of course. Or what am I saying? C shares, more like 2.09. Forget about that. Like, yeah, we definitely tend to stay away from the active management for the most part, though. You too?
Yeah, yeah, and I'm not going to tell you exactly how to build a portfolio, but remember, there's also, if you believe in modern portfolio theory, you believe in index funds. Remember, pretty much all these fund families have the exact same lineup with different names. I'm going to give an example here, like the Vanguard U.S. Total Stock Market, very similar to Schwab U.S. Broad Market, very similar to the Fidelity Total Market Index. Talking about pricing, Fidelity has zero cost ETFs now. They're literally called their zero funds. But, we have these pre-built allocations in different buckets just to give, especially clients for a one-time plan, an idea. But if you could see our fund lineup right now, they're pretty much all the same exact funds, just at a different Schwab, Vanguard, or Fidelity. Those are your three largest custodians that we see day in and day out. And this goes everything from extended markets, which that's usually mid caps and small caps, maybe a little bit more lean towards mid caps. Don't be scared of international. International is still an important part of your portfolio. We learned that last year. We're learning that so far this year. Don't forget about emerging markets. And then depending on what portfolio we're talking about here, you want to have some bond mix in there as well, depending on the goals of the account. But that's where we look at like the tax exempt bond funds, which AKA those are just municipal bond funds. And then we also will sprinkle in like total bond market funds. So again, if I could show you this list, they're almost identical. The only one, Schwab, I don't think, at least when we built this, Schwab didn't have an extended market. So we did actually two separate Schwab funds, a mid cap and a small cap fund, where Fidelity and Vanguard, we use their extended market to kind of keep it simple. And all of our portfolios, we got 6 or 7 funds when we're giving the blueprint to clients to go with. Again, when we build it in-house, it'll look very similar, but we might add some satellites in there as well, where we might think, a certain sector might do a little bit better or had better valuations. But again, we won't tell you the specific funds, but if you're looking at total stock markets and you're looking at extended markets, total international, emerging markets, those larger index ETFs are going to cover a large swath. And if you're building portfolios like that, you should be in a pretty good spot. The key is control your emotion. The difference when you pick the S&P 500 versus a total stock market, you're likely not going to notice a difference long run. But if you're trying to time the top, time the bottom, that's where you're going to get in trouble.
A point of caution about the Fidelity Zero funds. If you put them into your taxable brokerage account at Fidelity, because you can only own them at Fidelity. If you ever want to leave Fidelity, you either have to pay the capital gains tax on the profits, presuming it's grown since you bought it, or you just have to keep that Fidelity brokerage account there for as long as you don't want to sell the position. It's really annoying.
Yeah. And there's more of those types of funds out there than you would know, where they're like labeled as proprietary.
Yeah.
We had a large client come over from a large firm. The initials might be EJ, and they had a lot of similar type funds that were, and this was a large client. And good thing is there was some good losses in there that could offset cleaning those positions up. But to your point, when you're building these portfolios, if you're not in your forever home, just be cautious there. Because remember, you can also be at Fidelity and add in Vanguard funds. You can be at Vanguard and add in Schwab funds. You can be at Schwab and add in Vanguard funds. You can mix these things up. It doesn't, just because you're in that one custodian doesn't mean that you have to use their funds. So just keep that in mind as well. I think coming down the home stretch here, Tyler, one of the questions was how to balance. And I think we covered that well on kind of how to think through those. Another question that I enjoy this question because I think sometimes it can be, we attach to words. Rebalancing is one of them. Tax loss harvesting, tax gain harvesting. And we kind of get caught up in it thinking like, oh, we must have to do this a lot, right, to make it work. Their question was when to rebalance. What are your views on rebalancing?
Assuming one is taking a tax efficient approach where you make sure that you're not moving assets in the taxable account in order to affect the rebalance, I'd say quarterly is a good option if you can automate it. And a lot of times you can I think even like the Fidelity, like on on the retail side, I think that you can set it to like automatically rebalance like every set period of time. I would just, whatever you do, I think rebalancing it has usefulness. Increased frequency, it's not necessarily worth it if you're having to manually go in there and like run the numbers again and check and do it all manually. So if you are doing it manually, I think once a year is fine. But if you can automate it, so it's like, yeah, every quarter just rebalance the tax protected or tax deferred accounts. You could do it that often. I think that's fine. But you have to be careful to then pull in the data from the taxable account and see what's happening with that, so that that can inform how the tax favored accounts are rebalancing. So it might take some tweaking, but quarterly if you can automate, yearly if you can't. What do you think?
Yeah, I'd even say we're probably more of like a on average once per year is how we think of it. To your point, in the qualified accounts, not really a huge concern there. Almost every platform today you're trading for free. In the past, that wasn't always the case, which there would be like a cost conversation in there. I've always been a 3 to 5% drifter. So if you drift outside of 3 to 5%, likely a good time to rebalance in there. There's going to be some little shifts here and there that you're okay. It'll probably come back. New money will come in that also rebalances it. I do like automating. Anything you can automate is a good idea, especially like inside of your 401k, 403. Almost all of those will give you this chance to say like, hey, rebalance annually on my birthday or whatever the example would be. You gave a few notes on it too. Just be careful on the taxable account. The taxable account is the one where I would not be going out of my way to rebalance if it's going to trigger taxes on like micro events. Now, if they're larger events, yes. But with taxable accounts, at least probably for the bulk of our listeners and clients, is they're likely also saving new money to those accounts. So in a perfect world, you get a chance to rebalance every time new dollars come in. So more than likely, that account won't drift too much out of alignment, or you had an asset class do really good or an asset class do really bad. But keep an eye on that. And even if you're pulling funds out, if you have to pull money out of a a non-qualified account, that's another good chance to rebalance. So you'll have good opportunities in there to rebalance just on your day-to-day activity. So automate, probably can do it more frequently in qualified accounts. Be careful inside of the taxable accounts, just not trigger stuff for Uncle Sam and the gang there. But I think those are good numbers to run with. What do you think, my friend? How do we do here? Did we build some good portfolios?
I'd say so. Yeah.
Anything to add?
It's good for those of you in medicine who are like learning about investment management. Once you do learn it, there's a lot of things that you could assign it as like, this is simple and you can do it yourself. If you continue to do so yourself, make sure that you are getting professional advice at least sometimes. I know a lot of, and I mean it, a lot of doctors who have DIY'd for years, and they read the online forums about investing and they have done a lot of good things, but boy, have they missed a lot of things. So just because you know how to do asset allocation does not mean that you don't need any help at all with financial and tax planning. So make sure that you're getting some support, because no one should be an island in this regard.
Very good point. Yeah. Remember, there's a lot of great financial advisors out there that are doing one-time plans, hourly planning. Have someone double check your math, look for areas to optimize. You only know what you know. Same reason why Tyler and I are not using WebMD to diagnose that ingrown toenail that we think might be stage 4 toe cancer. We just can't trust everything we read out there, or they don't know all the details of your exact situation. So keep an eye for those opportunities to have someone come in and look to optimize, or just double check your work. I'm always impressed by how many one-time plans we still get year in and year out on individuals that are kicking butt. I mean, doing a great job. And just a little tweak here, a little tweak there. I didn't realize that. So well said, my friend. All right. Hey, Evans, thank you so much for the question. For all of you thinking, how the heck do I submit a question? Well, you can easily submit a question. We have those in our notes. We have them on the website. Go to the website, physiciansense.com, scroll down, and guess where those emails go? They go right to Tyler and I. And usually they come to me twice, because Tyler always forgets that I get the email and he still forwards it to me. So we see it not only once, but twice. So send us your questions. I can't say this enough, Tyler. I know you'll back me up on this. I would rather record every single episode for the next 20 years with you, Tyler, because of questions that we're getting from you all. So submit those questions. We'll love to deep dive. Hey, Evans, thanks again for this. It was a good question. And again, a topic that I feel like we needed some more investment topics anyway. So this was well timed.
Mm-hmm.
All right, my friend. That should be episode 54. I'll catch you on the next one.
See you soon.
All right. See you, Tyler.
This information is for general purposes only. This information is not intended to be a substitute for specific professional financial or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Wheels Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.